Now, the other thing I wanted to point out is I'm going to take a concept that is really very simple. I'm going to complicate it for a minute, and then I'll simplify it again, okay? And that is how to value inventory. Now, when we're taking a physical count, what are we doing? We're counting how many items on a shelf or how many items on a floor or something like that, right? And then we're multiplying it times what? The cost, right? What cost? That's where it complicates it. What cost are we using? Are we using the most recent cost? Are we using an old cost? Are we using an average cost? What are we using? Okay? Well, that's not easy, okay? You can't just say when I feel like. You've got to make a decision. Okay, now, if we were using specific identification, that would mean that we knew the exact cost of everything out there, correct? If we had 10 cars, each of them had a stock number, we know exactly the cost of stock number 1001, stock number 1002. We can just add those costs together. We have a very accurate value in our inventory, isn't it? That's specific identification. But do we use specific identification for everything? No. So for inexpensive merchandise, we're going to have to use a different method. Now, there are two methods that are used in valuing inventory. One of them is used more often than the other by a whole lot. But the two methods are called FIFO and LIFO. Now, what does FIFO stand for? First in, first out. What does LIFO stand for? First out. Okay? Now, a lot of you knew that before. You at least had heard the term before, right? Okay, that works too. Okay. Now, LIFO and FIFO can render significantly different results even though they're talking about the same inventory. They are referred to as assumptive methods, meaning that you're going to make an assumption. When you're not tracking every item specifically as to cost using specific identification, then you're going to have to make an assumption as to which items are still on the shelves. Let's just go through a scenario, and then kind of a very simple scenario, actually kind of funny, but on January 1st, let's imagine that you sold cans of carrots, okay? And you had 5 cans of carrots on the shelves on January 1st. They cost you $1 a piece. So your beginning inventory was $5, okay? Now, it took you a little while to sell those 5 cans of carrots, so you didn't buy more cans until April 15th. On April 15th, you bought 20 more cans of carrots, but now the price had gone up to $1.50 because farmers were having trouble growing carrots, and so you paid $30 for those 20 cans, okay? Took you a little while to sell those 20 cans. We're not talking about a high-volume business here. And on September 15th, you bought another 20 cans of carrots, but now the price has gone up to $2, so now we're up to $40 for those 20 cans. Now, that's just setting us up for what the next question is. On December 31st, we had only sold 5 of those cans. We have 15 cans left. The question is, what price are we going to use to value those 15 cans of carrots? And that's where we come up with making an assumption, okay? Under the first method, which is called FIFO, we're going to assume that the first ones in were the first ones sold, okay? So which ones are left? That's right, it is. Which ones are left? We're assuming that these 15 cans came from those 20 cans. And as you said, Ethel, that's a very good assumption. Because most people, that's the way that they rotate their inventory, isn't it? I mean, you look at a grocery store, the stocking people, they're pulling up all the inventory that's back in the back. They're pulling it to the front, and they're back filling. They're back filling in the back, right? So that you're always buying the older stuff, and the newer stuff's back in the back, right? Okay? Well, that's typical, and so a lot of people use FIFO. This is the most common method, and by default, if you're not using specific identification, FIFO is the method you're likely using. Okay? So to value this, we're going to say, well, those 15 cans we assume came from this group at $2 a piece, so we're going to multiply 15 times $2. Our inventory is $30. Okay? That made a lot of sense. LIFO says what again? So which ones were the last ones in? On September 15th, right? We're saying that those were the first ones sold. So which ones are left? 5 from $1 for $1, right? And 10 from $1.50. So let's do some math on that. That's 5 times $1. So that's $5. And then we have 10 times $1.50. So that's $15. So the total is $20, right? Now it's the same 15 cans of carrots. But the value is significantly different, isn't it? Because we're using a different assumption. Now recognize that most inventories don't go through hyperinflation like this. So the difference might not be as substantial from year to year, but over several years, the valuation can be significantly different. Okay? Now, does this make sense to you? The math is there, isn't it? Okay? It's clear how we got the math. But what this is saying, in essence, I mean, if you want to picture it that way, is that we are always selling the newest stuff first. So that means the old stuff, those cans of carrots, are getting older and older and older. And if we still have, if every year we end the year with 15 cans of carrots, then every year our value of inventory is going to be $20 from there on out, right? And what if in 20 years from now a can of carrots costs $20? What will our value of inventory be using the LIFO method? Still $20. Okay? So, the value of the LIFO method is one. There's one value to it. Only one, and that is tax purposes. Okay? Because the method that gives you the lowest inventory value will also ultimately result in the lowest net income for tax purposes. Okay? And so, for tax purposes, LIFO is good for most businesses. However, recognizing that, FIFO is by far the most commonly used. If you wanted to use the LIFO method of inventory valuation, you have to make an election with the IRS. You have to send in a form, usually have to pay a fee, you have to refigure all of your past income statements for the old system based on the new system. And so it takes a little bit. And so small companies rarely, if ever, will use the LIFO valuation method. There's really only two methods that they might use, either specific identification or FIFO. Those would be the two methods. Okay? And in doing, so does that make it simple again? So when you're looking at the cost of inventory, typically what you're doing is you're just looking at the most recent invoice or looking at the pricing list that the vendor has given you recently. That's usually how you're valuing. Okay? Interesting. Okay. Let's go to entry B. Entry B is to adjust or mark down inventory for obsolescence. Okay? Now, in the textbooks, we refer to it as the lower of cost or market, which means that if an inventory item will no longer, has gone down in value and will no longer sell at cost, then its market value is less than cost, and we want to recognize those items. Hopefully you don't have any of them. But if you do, and particularly if a lot of your inventory, the value, market value is less than cost, you need to recognize it. Okay? So, now this happens in the fashion industry. We had a fellow who sold clothing. He never had a sale. He wouldn't have a sale. They were men's clothing. I don't know if you folks remember, I'm really dating myself here, but do you remember the old leisure suits that were in fashion for about 15 minutes? Do you remember those things? Well, he bought the ranch on these leisure suits because he bought a ton of them in that 15 minutes. Got them in there real quickly, and the moment he bought them, they quit selling, okay? And so he had them on the shelves, but he wouldn't hold a sale. And so it got very difficult to sell those things. And we started marking them down a little bit by a little bit, not on sale, but just try to mark them down. He probably still wears leisure suits exclusively just because he couldn't sell them. Their market value dropped well below the cost. Okay, and so it does happen from time to time in clothing that this is the case. It can happen in, neighbor rejects. It can happen in parts departments and for automobile dealerships. It can happen in a lot of different places. Once the market value drops below the cost, we need to recognize that. So in this no-name business, we identified that $2,000 worth of obsolescence in our inventory. In other words, there were several items that the difference between market and cost was $2,000, where market was less than cost. So we need to mark it down an additional $2,000. Make the entry to reduce inventory $2,000.